A few weeks ago, we had a brief moment of sanity, maybe, when the market was beginning a rotation to value stocks. But that was short-lived as the market switched back to growth in a panic. As a result, Friday we saw record highs for the NASDAQ and the S&P 500. And value stocks? Not so much. This market action could be deja vu all over again, as with each passing day. The failure of Congress and the administration to reach a deal on extending fiscal stimulus creates a bigger and bigger hole in consumer cash flow. Investors have brushed this off for now, which could be a mistake. And that's because the federal stimulus payments that flowed to people in the second quarter was the largest on record. Removing that punch bowl of stimulus could risk a hard landing for consumer spending. But until then, everything is awesome. Today, we continue to search for answers to BR's questions. So let's take a look at our charts. In the previous video, we left off with the 20-year monthly chart on the spiders, the SPY, and so today we'll take a quick look at the 3-year weekly chart and also on the daily chart on the SPY. And as you can see here, Friday's close was 339.48. That is a record, just barely eking out the previous high way back there in February. So although we have eclipsed that mark there, I don't think that we're safe yet. Now, we've had a pretty good rally all the way from the bottom there, so it's been pretty strong and spectacular, but sooner or later it's going to run out of steam. It's still going, but as I've told you before, I've pulled off about 20-25% of my money, which is going to sit on the sidelines for now. The rest of my money is still in tech stocks, and they continue to ramble on. Moving here into the volume, you can see that the volume has tapered down. I don't like seeing such a sharp taper to the volume, especially in the last couple of months or so. So that is a cautionary sign. So our first cautionary sign there to match up with what we see in the 20-year monthly chart we talked about last time. Now, here's the MAC. We can see from that bottom here a very strong rally all the way on up here. Fast lines at 9.65 and the slow line at 5.4. That separation is still very strong, and that's built on all the money that the central banks have been putting into the markets. So right now, in my humble opinion, it looks like a melt up, but that can continue until they pull away the punch bowl. Now, once they pull away the punch bowl, things can turn fast, but the separation between the fast line and the slow line being this wide means that there can be some sideways trading action, maybe some volatility before things do turn and head down. We had melt-ups here, if you remember, back at this point here, and then also here. So a number of market periods to take a look at and compare. Moving on down here into the histogram. The histogram has been strengthening, but only marginally. So I think it's going to tire here soon enough because we started out pretty strong, and then we're starting to, say, slow down as we move here into the current time frame. So that is going to turn down sooner or later. Now, into the price rate of change, we definitely see the first negative of the oscillators definitely weakening. Into the relative strength, also another sign to me that things are not all that rosy. That peak there with the level here, which is, again, the divergence that I've talked about in the previous video, but you could see this downward trend here in the face of an upward moving market. Another example would be here to here, definitely a downward trend, and that in the face of an upward moving market. So these divergencies you want to keep in mind and pay attention to. Into stochastics, as opposed to the MAC, the stochastic fast and slow line are pretty close together, which means that things are weakening. You can see that as we move up here in these stages, say first stage, second stage, maybe a third or fourth stage here, but you definitely can see the narrowing of the fast line and the slow line. We're getting toward the peak. So the next move is going to be sideways and then down. That's going to be one of your timing signals, stochastics. Williams, this is also a good timing signal. When Williams heads down below that 20 line and perhaps even further down to that midline or 50 line, that's a good timing signal as well. Now, my trigger is the MAC, and I wait for the MAC for the most part, but I've already pulled some money off. So, as usual, more recently, I have been a bit quick on the trigger. I just don't want to wait for everybody to head for the exits. Back up here to the price chart. One last look. Let's go to the daily chart. And a quick look at the daily chart here. And as you can see, we definitely have a pretty good momentum running through here. I don't see anything on the price chart that is going to tell me that the market's about to correct. Down here into volume, you kind of see the same sort of thing. We've talked about continuing to decline. That's a cautionary signal. Here with the MAC, when the MAC, the fast line, and the slow line move together, when they're intertwined, moving together sideways, you have your melt up. And definitely we saw that here. So this could qualify in the last, say, couple of months, month and a half or so as a melt up. And they never end well. You see the same sort of thing there in the histogram with very little volatility in the movement. Down here, also price rate of change, you're going to see the echo of that lack of volatility in that oscillators as well. And here you're in your relative strength, somewhat the same as before, definitely a decline in that relative strength. And you can see this decline here as well. That divergence, you want to pay attention to those because that's a very important oscillator. Again, stochastics, and then Williams, they're not really showing much of anything right now. It's because the weekly pretty much is in control. Back here to the price chart. So once again on timing, just watch those oscillators at every measure, the monthly, the weekly, and the daily. And when those oscillators start turning and you get a predominance of those oscillators turning negative, then you're at or very near a correction or perhaps a downtrend in the market. So that's what I always watch. I have my favorite oscillators, and you can pick out your favorite oscillators as well. And to answer the question of how deep we will go if we have a correction, that's always a tough one to answer. And usually I take a look at 50% of the previous move. But this 50% could be from that point there to here. And maybe we only go down to this point here. Or 50% could be from all the way down here to up here. And in those terms, 50% might be someplace in this area. I can't really say. My best suggestion is to continue to watch the oscillators and also continue to stay with this channel. That's your best bet. And for today, that's ChewDog Charts. Thank you.